Y'all are being recorded now.
Okay. We're recorded, all right.
If you feel like anything you're saying and you want to not be recorded, let us know. Michaela can pop the button and stop the recording. If you say anything
Right.
that you
I don't
think
we'll
you
say
can
anything.
or will be held against you.
Yeah, I don't think we'll say anything. In fact, we'll have a disclaimer in a second. Good evening, everybody. My name's Jim Cochran. Like she said, I'm CEO and owner of Valley View Agri-Systems. This is Mike Kraft, our CFO. We are very glad to be here tonight. We appreciate the opportunity to present to you guys. They asked us to talk about the due diligence process. And I know with this being an entrepreneurial group, there's a lot to get out of the due diligence process. Not only to understand when we buy a business, which pertains to our situation, but it helps you understand what a potential investor is going to ask and going to look for from your idea or your company when you're pitching to them for equity or for a money raise. So hopefully this will be helpful for you guys. We'll try to make it, I guess, tied to real life experience as much as we can and try not to bore you with a lot of bullet points and details. I know this will be available later, so you can use it as a reference. So for that reason, we'll try not to just read off the bullet list, and we'll try to get this thing going. So I had to do the disclaimer. See, Mike put this in here for us. Actually, he did this whole presentation, so I need to give him credit for that. But basically, this is for information purposes. Neither myself nor Mike are an attorney or financial advisor of any kind. So please just take this for informational purposes, and hopefully it will be helpful. If not, please don't sue us. So I guess I'll kind of, I want to, I guess, first tell you a little bit about our company and our background, just to give you some reference before we get into the meat of the deal. But our company is Valley View Agri-Systems. We're headquartered in Jonesboro, Arkansas. We basically specialize in the design, the construction, the service, and the part sales for grain storage facilities, grain storage and handling facilities. So big shiny grain bins you see on fields around here, and then large commercial operations that you see at the elevator or the river facilities that load and unload barges. That's what we do. We also have another division that sells parts and industrial supplies to manufacturing facilities around Jonesboro. But our Jonesboro location serves about 5 states, and including Tennessee and Kentucky, Arkansas, Texas, Missouri. We have another location in Cleveland, Mississippi that serves Louisiana and Mississippi. We've got about 100 employees, and those consist of construction crews, service crews, warehousing, trucking, inside sales, outside sales, accounting, and other office personnel. Our company started in 1980. I came in December of 2012 and bought the majority interest of the company from the founders of the company. Previous to that, I spent about 10 years in commercial banking in Memphis, where I was born. And previous to that, I was at Mississippi State, where I got my bachelor's and my MBA degrees. I guess the one background story is obviously at a fairly young age involved in acquisition of companies, so it's been a learning process. I'll tell you that buying and operating a company has been quite the roller coaster, plenty of ups and plenty of downs. But I guess the bigger picture as it relates to today is the reality is that there's only so much you can find out and know about a company before you actually buy and operate the company. That said, if you go through a very thorough due diligence process, like I think is outlined in Mike's presentation, that certainly will help minimize the risk and help you make a more informative decision when you're looking at an opportunity, whether it's to buy a business, invest in business, or to know the process, to know what the other side of the table is going to ask of you. So I'll let Mike introduce himself and say a little bit.
Okay. Well, I began my career in public accounting with a very large firm called Arthur Anderson. And other than the 2 or 3 over 50, does anybody have you heard of Arthur Anderson? Or Enron? That might be a hint. There is no Arthur Anderson anymore. It went away back in the 90s. But at the time, it was a very large CPA firm, and I was there 11 years in the audit and business advisory division. Did a lot of mergers and acquisitions consulting for my clients. So what we're going to be talking about, I did as a consultant for a number of years. And then went into industry after I left Arthur Andersen, went with a timeshare business a couple of years, and then in the hotel business with Peabody Hotel Group for almost 20 years as their CFO. So then I was doing due diligence and acquisitions and what have you on the company side. And it's a lot harder then because you have to live with whatever you buy instead of just consulting and then walking away. So after about 20 years, I left there, and the bank that I used while I was at the other company was also the banker for Jim at Valley View Agri. So I called up and let him know I had left, and he said, man, it's a coincidence. The guy down the hall from me just got a call from his client about an hour ago, and he needs a CFO. So Jim and I met that day, and one thing led to another, and here we are. So anyway, it's a pleasure to be here, and thanks for having us.
All right, we'll jump right into it. So the purchase or sale of a business, basically the merger and acquisition activity begins at the time of either a business is offered for sale by its owner or a buyer decides to acquire a business. The early stages of these activities may involve the use of a business broker, investment banker, or some other third party. In my case, I was in commercial banking, and a colleague at an investment banking group in Memphis called and told me a little bit about the deal and asked me how I would structure the financing for it if they were to find a buyer or to line up the right buyer. And basically, I just learned more about the opportunity. I'd always hoped that I'd be able to help myself buy a business rather than help other people continue to buy good businesses. And this one kind of fit the bill. So I went through my hat in the ring, and that same investment banker helped me and the other potential buyers and the seller kind of interact and helped navigate that process. At some point in the M&A process, the buyer and seller will conduct some form of due diligence activities. And that's what this presentation is focused on. Due diligence, I think this is a pretty thorough outline of the process. It can be anywhere from as small as a couple of questions to the link that we're going to go to. It really just, you want to do as much as you can, but obviously within reason of cost and benefit and what's possible. Primary components of an acquisition: identify the targeted business, negotiate the price and the terms of the transaction, execution of various documents. Usually at this stage it'll be a confidentiality agreement, non-disclosure agreement, something of that sort to make sure that the information disclosed is not privy to outside parties. Then you actually do the due diligence process, which can entail all of these things: financial, tax, legal issues, capital, and then you have the closing of the actual purchase. And by that time, you feel like it's been 10 or 12 years and you've lost a couple of years of your life. Common documents used in the purchase of a business. Usually there's two primary documents. The first is the letter of intent, and the second is the purchase and sale agreement. The letter of intent, which is often referred to as an LOI, is really just an agreement to negotiate on the transaction that's being discussed. It's generally non-binding for either party. It sets forth basic principles of the soon-to-be purchase and sale agreement. It has minimal details of the upcoming transaction. Obviously, that it kind of runs the gamut. I'll talk about this later. You want it as detailed as you can on the front end, but it's in general most of the time. Anticipated purchase price and the basic terms of the transaction that you're discussing with, in our case, the seller. Then you have the purchase and sale agreement. First, let me back up on the letter of intent. It says very general, but it's the first step of really having meaningful discussions on the deal. And so I think as much can be covered and included in the letter of intent, whether it's outlining the structure of the deal or the due diligence process, et cetera. It really helps get the two parties more on the same page at the beginning stage. And that just makes the next step, which is the purchase and sale agreement, easier, because the negotiating and ironing out the purchase and sale agreement is difficult enough on its own, just because that is the agreement. It's the holy grail of the documents that will be negotiated in the deal. It's very detailed, usually lengthy, specific price, method of payment, etc., terms of the closing, when it's going to close, where the money will go, how much is going to go where it's coming from, really everything that needs to be covered. And then it also entails the due diligence process itself, which is somewhat confusing since this is the purchase and sale agreement. But it's being negotiated, and part of that is negotiating what the due diligence process will be. And that's really important for the buyer and the seller to negotiate what will actually be included in that process. What is the seller willing to let the buyer do to understand the business, to look at the financials, to understand the employees, the customers, and everything about the company. So that's also included in this, and that's a really important part of the document. And although a purchase and sale agreement might be executed, you might sign it and close it before some of the due diligence items are done. You always have the right, or you have an agreement, the right to go back and renegotiate if something was found during the due diligence that makes that necessary. And that's the point I just stated. Mike, would you take over?
Okay, we'll talk for a minute about exactly what is due diligence. Well, due diligence is a process during which you, as a buyer, a potential buyer of a company, learns as much as you can about that business so you can make a good decision. And it's an act of gathering as much information as you can and then evaluating the information and deciding what to do about it. So it's a process, typically fairly lengthy and very detailed. It's your big chance to learn as much as you can before you go through with something. Now, we're going to be talking about due diligence from the standpoint of a buyer of a company. Due diligence can apply to anybody and anything. It can apply to a seller because they may want to do due diligence on the buyer, and we'll talk about that a little bit. It can talk about if you want to go buy a car, you will conduct due diligence. I drive my wife crazy with my due diligence on a small TV. And she's not like that. She would just buy one, but I don't. I conduct a lot of due diligence because I want to make the best decision possible. There are a number of parties that have an interest in the due diligence process, and all of these parties typically benefit in one way or the other. The buyer definitely is probably the primary one that has the interest in the due diligence process. The seller knows what they're selling. The buyer doesn't know what they're buying, so the buyer has a big interest in this. The seller, in some ways, although the seller could be hurt by the due diligence process, because depending on what the buyer finds, they may or may not go through the process. So the seller could lose their sale of the company through the due diligence process. And then there are other stakeholders as well, including investors, lenders, employees, customers, vendors, and attorneys and accountants. Attorneys collect lots of money from due diligence processes, so they love this kind of work, and accountants do too. So just about any professional services will drive up a fairly big bill in a lot of situations. So let's talk about how the buyer benefits. Well, the buyer gets enough information to be able to decide whether to go through with the transaction. That's the big benefit. And by doing this, the buyer will have fewer surprises when they take over the business. There's always things that you'll learn that you didn't find during due diligence, but the more thorough the due diligence is, the fewer surprises you will have after the deal is done. The due diligence process allows the buyer to prepare to operate the business. It's sort of like a free trial during which they will learn about the business and what runs the business and what the issues are, so that when the time comes, they can just hit the ground running and they know a lot more about the business than they would have otherwise. The buyer is able to develop a business plan during this period of time. So it's sort of like a free period during which you can do things without having to deal with running the business, rather than wait until you get the business and then have to prepare a plan or decide what to do with things or what have you. The seller benefits. The due diligence process would typically allow the sale to go more smoothly rather than just trying to throw everything together and get it done. It reduces the likelihood of disagreements after the sale. Since the buyer finds out a lot more about the company, they can make a more informed decision, and it lets them work things out before the closing. and it allows the seller to deal with tax issues regarding the deal. That's usually a very big deal for the sellers. There are a lot of tax consequences, so you need to be able to decide what those are and how to handle them ahead of time. A lot of times after the fact, it's too late. You're stuck with whatever the tax issues are. Other stakeholders. Employees, customers, and vendors are aware of what's going on, and they feel more included. You know, think about yourself. Anytime that you're involved in something before it happens, you have a better vested interest in making sure this thing works. It's sort of like you own a piece of it. So that's a lot better than just throwing these people into it all of a sudden. Investors and lenders are more likely to get repaid later. The buyer knows what they're getting into and knows better how to run the business and whether it can afford the debt and other things that they're going to get on the new business. So people like to get their money back when they put money into it, and this helps them get repaid. And we already talked about that. You'll have an interest, and it sets a realistic level of expectations for the new company. If you buy a company without any due diligence, you may have an idea as to what to expect, but your idea may not be realistic. And due diligence helps you develop a level of realism where you know what you're getting into and what will happen after the acquisition. And if everyone's happy and contented, your life's going to be easier. And most importantly, a good due diligence process lets the attorneys and accountants send their kids to school, and it helps the whole world in that way.
My father-in-law, who's Frank, and an attorney's here, so I'm not going to comment on that.
Yeah, we're covered on both of those.
All right, what about a business is important to the buyer, and a lot of these will be applicable. What about the business is important to an investor, to an early stage company, or to a late stage company? Obviously, it's operations, the financial strength of the business, the value of the assets to be acquired, and the liabilities that will be assumed. There are various ways to structure the purchase of a business. From a buyer's perspective, just for reference, when we did ours, it was an asset purchase, and the primary, there are a lot of reasons, but the primary one is you know the assets you're getting. You never know what liabilities could be hanging out there, either known on a financial statement or liability from something else that's hanging out there that you might not be able to know about. So in our case, we created a new entity and bought the assets to put into that, and then our own liabilities went against those assets when we structured the deal. It's management, other key personnel. Will they stay or go? Do you even want them to stay? What do they do? Do we need to focus on certain employees and managers and address it before a transaction happens? Do you want to work them in the deal? Do you want to put employment agreements in place? Do you need something in place to ensure that as a buyer, that when you do the transaction, they're not going to leave the company and all of a sudden leave you hanging because they were one of the reasons you wanted to buy the company, because they are what make it what you wanted to invest in. So I think that's very important. Also, from an investor standpoint, obviously you want to know who those people are for the same reasons that a buyer would. Tax issues, contracts, litigation, other legal matters. What will the buyer have to live with going forward? Obviously, any contracts that are in place that are negotiated into the deal, you want to be able to understand your obligations now that you're going to own that company under those contracts, and make sure you're comfortable with them or don't need to have anything addressed prior to the purchase. And then technology. Environmental issues and regulatory constraints, obviously that could be a factor depending on the industry of the business that's being invested in, and then others. All right, what else does the buyer need to know? Obviously, all sorts of financial information of the company. At the end of the day, the reason why you're buying a business or investing in business, as Mike said, is to get your money back and hopefully make money on the money that you invested or the company that you purchased or invested in. To do that, you need financial statements. Mike says as many as you can handle. Annual, monthly audited statements are preferable. This kind of ties into something that I'll probably talk about later, but one of the biggest things from a buyer's perspective is assembling the right team of specialists that know what you don't know really well, and that you can partner with, and that will go specialize in their areas in the due diligence process, such as an accountant or an attorney, who are going to focus in their respective areas and find the information that you might not even know you need to look into or to get. Other financials, accounts receivables, payables, inventory. Among other things, the buyer needs to identify what it wants to include and exclude in the purchase. That relates back to the asset comment of determining what you do want to be included in terms of the assets of the company and what you don't. There's likely to be items that you don't want to be included in the company for various reasons. What it will cost to buy the company and how to pay for it, sources of revenues and the uses of the company's cash, obviously extremely important for the viability of the company and future opportunity. And you need to understand the potential risk from acquiring the business. There are risks in buying any company of any size in any industry. There's always risk, and so understanding your risk as much as possible helps you address it on the front end, and helps you vet the opportunity, and helps you determine if it's something that you really believe is a viable investment for you. And then upside of an acquisition, like I said, you're in it to get your money back and to make money on your money, among various other reasons, of course. But you need to understand what the upside of the acquisition could be and would likely be. What should the buyer do with all this information? Identify and evaluate what it will be getting, which is easier said than done, which we'll talk about that a little bit later, but goes back to the comment is there's only so much you can know. So, identifying and evaluating as much as possible to understand what you're actually buying is extremely important in this stage. Risk and opportunities of buying the business. Develop a prospective financial model with a newly acquired business. So really important, obviously, you can look at historical financials and understand how the company is done under its current ownership, under its current structure. However, that's really important to understand the likelihood of what's going to happen going forward, but you're about to buy it and probably run it different and probably make some different decisions. You understand that there's different opportunities that you like to pursue and hopefully grow the business. So a financial model allows you to take historical financial statements and take your beliefs on what will happen after you buy it and put a model together, and that does a lot of things. It obviously it helps you envision of what you think the opportunity is under different scenarios, bad and good. You want to see, and my best case scenario, how do I think the company will do if something happens and we lose a big account or the economy goes down? How does this look if sales go down 40%? How does it look then? It helps you really look at the company under a lot of different scenarios. It also helps you structure financing. If you're going to bank to get a loan to help you buy the company, or you've got you're wanting to look at maybe the seller's willing to finance part of the deal, and you're getting a bank loan for the other. This really helps you put the debt service that you know you're going to have from those loans and apply it to that financial model that's based on how the company's done in the past and how you expect to do it going forward. So it really helps you back into what the structure needs to look like for it to be a meaningful investment for you or your investors. And that goes to the cash flow as well. And you use it to assess the final negotiation of the price and the terms of the deal. And use it as the final decision whether to go through with the actual acquisition or not. Obviously, if you play around with the numbers and it doesn't pan out quite like you thought it would when you first looked at the opportunity, you better change your mind and move forward.
Okay, we're going to talk about the plan for due diligence. If you start a project like this, you've got to plan it ahead of time. Otherwise, it's just chaos. When you get in it, it doesn't stand a very good chance of success. But obviously, the ultimate objective is of making an informed decision as to what to do with this business or transaction or whatever it is you're working on. So that's the bottom line of the plan, where you want to end up. The plan should be prepared with all the key players having input, including the seller to some extent. You can't do due diligence without the seller being involved and buying into what's going to happen. A written plan is always better because it just makes sure that everything is documented. It lets you remember everything to be done, what needs to be done, who's going to do it. So anytime you can come up with a written plan, it really helps. And it has to be realistic. You know, obviously some transactions demand more due diligence than others. You know, Jim and I, if we bought a company this size, we would do a certain amount of work and things. If you go by General Electric, you're going to do a lot more work, and it's going to involve a lot more people. So it has to be structured to fit within the parameters of what you're getting. The objective is to conduct a reasonable investigation based upon whatever circumstances are involved. The design of the plan, each one is unique. It should all be designed to address whatever transaction you're dealing with. They will all have some common core components typically that you would deal with, but otherwise there's going to be a lot of things that apply to one that wouldn't apply to the next one. It should address the concerns that are likely to be associated with this company. Depending upon the industry, the maturity of the company, the sales types of transactions that you do, the people that you have, everything that all of those things play into different concerns that are different with each company. And the plan should address how you're going to do it. You know, what you're going to do, who will do it, where will you do it, and when will you do it. Think about in elementary school, you had this invitation to a birthday party, who, what, where, when, and why. Sort of like that, same thing. The bottom line, though, is that the due diligence process needs to evaluate the likelihood of future earnings and cash flow. I think Carol said at the beginning, you know, it's all about cash ultimately. So you've got to address how likely is it that you're going to get cash back on this, and how much are you likely to get. There are other reasons besides cash that should be considered. You know, a company may find this target company to be a good strategic fit within its operation, things of that sort, but it still boils down to cash in the end. Strategy or not, you know, the strategy is this company will help me make more money. So not to sound greedy or anything, but that's really what business acquisitions are sort of all about. So what should be done? The plan is intended to identify and evaluate what makes the business run, obtain and confirm data. You know, Jim was talking about get as many financial statements as you can handle. Bring in all this data, confirm it, evaluate it. Identify business-related issues. These are typically things that would be unique to the industry or maybe your geographic location or whatever it may be. But you want to identify all of these things at the earliest time possible. And identify and assess the risks. You know, Jim mentioned, what if sales go down 40% in a year? And most companies will eventually deal with this due to normal business cycles. So you need to identify what could happen and what might go wrong and decide whether you can deal with that and still have a successful business at the end. So who will do it? Well, the best person available is the one that would do it. Certainly a lot of the management team of the acquiring company, their attorneys and accountants, auditors, tax advisors, that's sort of the core group right there. Other experts as you need them. The ones that I've worked on, typically a lot of environmental issues come up. When I was in the hotel business, we sold and bought hotels, and hotels have dry cleaning and laundry facilities within the hotels. Those things spill chemicals in the ground, so we seldom did a deal without having some extent of environmental study done, and some of them really revealed a lot, so you need to get experts in as you need to. And all participants must be able to keep things confidential. The seller is really concerned about this. You know, they don't want their current customers getting nervous, you know, that they're going to be selling. They don't want all the employees thinking they're about to lose their job and jump ship. So a lot of this process is very confidential, and very few people may really know what's going on. But it's a balancing act to let people know what's going on, to not get too nervous, but at the same time, you can't tell them enough it's going to screw up the deal. And, in deals that I've been involved with before, I've lost pretty good friends, or I thought they were good friends, because they said, how could you be working on this sale of our business and not tell me what's going on? I just can't. That's the way life works. I'm sorry. Where to do it? Typically at the business location is best to the extent you can. It's always best because you get a feel for what goes on, you see the people, you see the business activity, you really learn a lot. And then at the offices of your lawyers and accountants or other consulting firms. And then finally, it could be a site, a business with lots of different locations, maybe around the region or the country or the world. And it's good to visit some of those and get a good sampling of what the different businesses are within the company. And when do you do it? Mainly whatever you can agree to with the seller. And this is typically addressed in the buy and sell agreement, purchase sale agreement. It should have specific beginning and ending dates. Typically the agreement would say you can do this work and you have 90 days to do it. And at that time, it's over. Get out. And then we're going to talk about the due diligence plan. And again, it should be agreed upon with the seller and other parties. Everyone has to know what to expect, what their role is. Some things will be allowed by the seller and some things will not. Sellers typically will try to restrict you to anything that they are concerned will upset their business. Now, hopefully it's not because they're trying to hide something, although you never know. It's entirely possible and it does happen. But mainly they don't want you disturbing customers, scaring employees, and things of this sort. But you have to agree up front and address it in the buy and sell agreement, exactly what you're going to be doing and what's okay. Due diligence work is usually very time consuming and it can be very expensive. However long is allowed for the work, it usually fills it up. And it fills it up sometimes day and night and really keeps a lot of people busy for a long time. Now, in the buy and sell agreement, you can have representations and warranties from the seller, where they say, we promise that this isn't a problem or this isn't happening or whatever. And that's good. It's good to have lots of those, but that does not negate the need for due diligence work where you go in and actually see what's going on in the business and confirm it and are able to evaluate it. The plan should address all areas of the business: operations, sales and marketing, financial, human resources, legal, tax, or other regulatory issues, information technology, and anything specific to the company and the industry. So by the time you get done with this, you'll have touched just about every aspect of the business and have a good idea of what's going on all around. And we're going to be looking at some of the things in a typical checklist. And there will be a checklist on here that you can take with you.
Alrighty. Due diligence checklist. Failing to plan is planning to fail. One thing is identify the overall objectives of the buyer and the seller. Obviously, it's extremely important, and it makes making the deal happen, negotiating it, getting it done on either side much easier and much more possible if you understand the primary motivators behind each party. Why does the seller want to sell? What are the motivators? Is it all about money? Does he care about the legacy of the company? Hopefully, he cares a lot about the employees that he's employed for however many years. But what are his primary motivators for selling? That helps you as a buyer or an investor understand kind of what approach to take and what to focus on and what not to focus on. Understand the financial needs of the buyer along those same lines. obtain approval from seller for lines of communication with the seller staff and for conducting discussions with employees and third parties. So this is one I get a little, Mike kind of mentioned, but there are very legitimate reasons for a seller not to want a buyer to talk to employees or talk to customers or be inside their walls, like Mike mentioned, because it's, first of all, if you're selling a company, you don't know that this deal is going to go through. Even though you're working on it, you hope it does, you're signing documents, it very well may not go through. And if it doesn't, there's a possibility you're going to go through the same process with another prospective buyer, the seller is. So in that instance, he's nervous to bring somebody in only to think that they might have to do it all over again, and it causes uncertainty within the walls of the company. People get anxious. People start looking on monster.com and see if they need to be looking for a backup plan. And the same thing with customers. If the message